So when conflict breaks out, it's totally natural to feel anxious about your investments. I mean, the headlines are everywhere. But what if you could actually turn that uncertainty into a clear-headed strategy? In this explainer, we're going to show you exactly how to navigate these turbulent times, not by trying to guess what happens next, but by focusing on the predictable economic patterns that almost always emerge during a war. Yeah, this is the big question on every investor's mind, right? And look, while the who, what, and where of any conflict is always a wild card, the economic effects, they often follow some pretty consistent patterns. You see, successful investing in these times isn't about guesswork. It's about understanding the fundamental forces that move money around when geopolitical tensions get this high. Okay, so here's our game plan. First, we're going to break down the core economic shockwaves that war sends through the system. You know, the why behind all the market moves. Then, we'll look at the specific assets that have historically come out on top, and the ones that have struggled. And finally, we'll put it all together into a practical playbook you can actually use to build a more resilient portfolio. All right, before we even whisper the name of a single stock or asset, we have to get our heads around the powerful economic engines that are really at play here. These are the fundamental forces that drive performance, and honestly, they don't really care where the conflict is or who's involved. Now, this is where things get really interesting. It's all about how quickly markets react to potential problems. Just think about a critical shipping lane, like the Strait of Hormuz. Over 20% of the world's oil goes through there. The second there's a threat to a choke point like that, markets slap an immediate risk premium on prices, long before a single barrel of oil has actually been stopped. Think about it. Wars are incredibly expensive, and to pay for them, governments have to spend a ton of money, and a lot of that is through debt. This fire hose of cash gets sprayed into the economy, which can fuel inflation and weaken the currency. And that kind of environment is a huge tailwind for hard assets, things that hold their value. This is classic human psychology, really. When uncertainty spikes, what do people do? They run for cover. Investors pull their money out of speculative, high-growth stuff and rush towards assets they see as safe. Think government bonds from stable countries or precious metals. This flood of capital moving from risk to safety is an incredibly powerful force. And if you want to see just how massive this government spending can get, check this out. During World War II, U.S. federal debt as a share of its entire economy literally tripled. That's not just a small bump. That's a number that shows you how dramatically a major conflict can rewrite a country's entire financial story for decades to come. So we've got the why down: supply chain chaos, government spending, and a flight to safety. Now let's talk about the what. Let's look at the assets that have historically thrived in these conditions. This is our roadmap for figuring out where to potentially shore up your own portfolio. Gold. It's the classic hedge for a reason. For literally centuries, it's been seen as a reliable store of value. Why? Well, its worth isn't tied to a government's promise or a company's earnings report. During times of crisis, gold is valued because it has zero counterparty risk. In simple terms, you're not depending on anyone else's promise to pay up. It just is. And the numbers really back this up. Just look at the oil crisis in the 70s. A perfect storm of supply shock and inflation. Gold went through the roof. More recently, in the first few months after the invasion of Ukraine in 2022, gold jumped 14%, which was a heck of a lot better than most other things you could have owned at the time. So if you're thinking about gold, how do you actually do it? Well, you've got a few main options. You can buy physical bullion, coins or bars, which is the most secure, but you've got to store it somewhere. Gold ETFs like GLD or IAU are super easy to trade in your brokerage account. Or you could buy mining stocks, which can give you leveraged returns. But remember, you're also betting on that specific company doing its job right. Energy commodities, especially oil and natural gas, are maybe the most sensitive assets to this kind of disruption. The market immediately starts pricing in the possibility of a supply problem, which sends prices spiking way before the flow of oil or gas has actually been cut off. And just look at the history here. It's a pattern that repeats itself time and time again. The 1973 oil embargo, prices quadrupled. The first Gulf War, they more than doubled. And in 2022, Brent crude shot up 75% because of fears over Russian supply. This is one of the most reliable trends you'll see in these situations. Okay, this one's pretty straightforward, right? When conflicts start, defense budgets expand, and they expand fast. Defense companies start getting a flood of new orders and, just as importantly, long-term contracts. That kind of predictable revenue is like gold when the rest of the economy feels uncertain. And the defense sector is way bigger than most people think. It's not just about weapon systems. Modern warfare is also about cybersecurity and surveillance. It's about military logistics, getting stuff from point A to point B, and it's about big aerospace programs. A conflict creates a sustained surge in demand across all of these areas. All right, so we've talked about the winners, but for every winner, there's usually a loser. And frankly, knowing what parts of your portfolio might be vulnerable is just as important as knowing where the opportunities are. So let's look at the assets that consistently take it on the chin during a war. This slide really tells the whole story, doesn't it? It's a tale of two completely different worlds. On one side, you've got defense, thriving on the certainty of government checks. And on the other, you have travel and tourism, which just gets hammered from every angle. Insurance costs go through the roof, fuel prices are all over the place, and who wants to book a vacation when things feel so unstable? Demand just evaporates. And it doesn't stop there. Emerging markets often suffer because of that flight to safety we talked about. Global money pulls out and heads for more stable shores. Consumer discretionary stocks, think nice-to-haves, not need-to-haves, get hit as people tighten their belts. And riskier stuff like high-yield bonds or commercial real estate get dumped as investors want nothing to do with extra risk. Okay, let's bring it all home. This is where we go from theory to practice. This final section is all about applying these lessons to your portfolio. It's about how you can manage your current investments and how you can position yourself for whatever comes next. So, what might a more defensive portfolio actually look like? Well, here's a sample framework. Notice how it's built around capital preservation. A big chunk in stable government bonds, another chunk in defensive stocks that sell essentials like utilities. And then you see our historical winners layered in: precious metals, energy, and defense. And that little sliver of cash? That's your secret weapon. It gives you flexibility. So how do you actually get this done? Let's break it down into 4 simple steps. 1, take an honest look at your current portfolio. How exposed are you to those vulnerable sectors? 2, start to rebalance. Maybe trim some of those risky positions and add to the defensive ones. 3, you can do this really efficiently with sector ETFs, like XLE for energy or ITA for defense. And 4, always keep some cash on the side. It lets you stay nimble. It's also super important to understand the typical life cycle of a market's reaction. Those first 3 months are usually maximum fear and panic. That's often the best window to add to your defensive positions. After that, the market kind of adapts to the new normal. And then, way down the road, as a resolution seems possible, markets start to price in peace. That could be your signal to start shifting back toward growth. Look, if there's one key idea to take away from all this, it's this right here. Stop trying to predict how the war will end. You can't. Instead, focus on the predictable economic machinery that gets switched on every time: supply disruptions, government spending, and investor psychology. That's where your strategic edge is. And that brings us to the final and maybe most important question. These events don't just create a temporary blip. They often trigger permanent shifts in global supply chains, in energy policy, in defense spending. So the real challenge isn't just surviving the conflict itself, but thinking ahead and positioning your portfolio for the new world that's going to emerge on the other side.